The revisions were intended to replace a portion of the property tax, and as a part of effort to correct the constitutional challenge to school finance, changes were expected to more evenly distribute the tax burden among economic sectors. And as you know, we fully implemented in January of 2008. The margin tax has turned out to be both a financial burden to the small businesses and to the Texas economy. It's complicated for the businesses that have to pay it and for the collector that has to administer it. And we're here today to talk about are the problems real or imagined with the margin tax? There have been a number of lawsuits filed and litigated, and a number that are on tap to be litigated. The tax is not performed up to the level that it was thought to perform. People have called, because of that, people are calling for fixing the margin tax. When I hear the word, let's fix the margin tax, what immediately comes to mind is, let's make it raise more revenue. We do not associate fix with necessarily more revenue. If it makes it more easily administered both on the side of those that pay it and the side of those that administer, that's fixing as well. Another way to fix it is that if it were to completely go away, that's another way, very positive way of fixing it. But we have a group of people today to talk about that. What about it? Are these real problems, or are they just opinions? And so we have our experts. We have, and they won't be speaking in this order, but Representative Charles Perry, Mr. Dale Kramer, Mr. Jimmy Martin, and Mr. Peter Nolan. And I think we'll have a very wide range of discussion and expect to for you to listen and to be ready to answer ask some good questions for the panel to answer. Now, if you don't ask a good question, you may not get a good answer, so be sure you have a good question. We're going to start out with Mr. Dale Kramer. He's the president of the Texas Taxpayer and Research Association. He's knowledgeable on Texas franchise tax. Primarily serves as an advisor to public officials on all tax and budgeting issues. And prior to being with the Texas Taxpayers and Research Association, Mr. Kramer was a director of budget and planning for one of our governors, chief financial analyst for the Texas House of Representatives, and at one time was the chief revenue estimator for the Texas Comptroller's Office. Please welcome Dale Kramer.
Thank you, Talmadge. I appreciate the introduction. I'll offer a little bit of background about my association, TARA, the Texas Taxpayers and Research Association. We are a large, broad-based membership association of primarily businesses within the state, also some individuals. A lot of our business members do business across state lines. They're larger multi-state businesses. But we are, for all intents and purposes, professional tax nerds, and it is in that vein that I come today to talk about the franchise tax. I will say, by way of full disclosure, in 2006, when the legislature undertook rewriting the franchise tax as a part of a broader package to deliver property tax relief, we did support the overall package, although there were some parts of in particular, the franchise tax that gave us some cause for concern, and I'll talk about those in a minute. But I'd like to offer a little bit of general background in pointing out that the franchise tax is actually the oldest tax, the oldest state tax that is on the books in our tax code. The franchise tax dates back to the early 1900s. Originally, it was a tax that applied to the net assets of a corporation. That worked very well until the mid-1980s, when as a result of a number of lawsuits, and Jimmy, I'm trying to remember if you had any of those, that resulted in some substantial refunds against the old franchise tax, which was based on taxable capital.
We did initially, but Caterpillar changed.
Oh, well, sorry about that. Win some, you lose some. But in any event, in response to substantial legal, I guess the term that was used, erosion of the tax in the late 1980s, it was rewritten essentially to apply to net corporate income or net profits. But nobody wanted to call it a net income tax, so they came up with the term earned surplus. So for years, we called it the earned surplus calculation within the franchise tax. That led itself to some planning opportunities that resulted in a number of corporations being able to plan themselves out of the tax using a combination of out-of-state entities, or in some cases, dropping their active business into a partnership, and partnerships were not subject to the tax. So there was this perception, albeit wrong, that the franchise tax was withering away to nothing in the early 2000s. And that sort of perception grew along with a series of school finance lawsuits focusing on the property tax. And in 2006, in response to a Supreme Court order to revamp our school finance system, the legislature adopted a package of revising the franchise tax, using that revenue along with some surplus state revenues and an increase in the cigarette tax to buy down local school property taxes. And local school maintenance and operations taxes were basically cut by a third. Now, that cut was largely illusory to taxpayers because it was phased in over 2 years, so it wasn't as noticeable. It got sort of lost as the result of growing property values at that time as well. But nonetheless, the franchise tax itself was not illusory by any stretch of the imagination. The tax was originally designed by former controller John Sharp, now chancellor at Texas A&M University. And the legend has it that John was at dinner one night and had an epiphany, and he sketched out this new franchise tax, or the margin tax, on a paper cocktail napkin, and this became the basis for legislation. Now, you can insert your joke here as far as cocktail napkins and tax policy, but in any event, that was sort of the seeds of how this tax evolved. As originally written in 2006, it was designed to convert this basically $2.5 billion a year profits tax into a $6 billion a year sort of a hybrid tax. It's sort of on gross receipts with some deductions, but it was clearly not an income-based tax, at least by the traditional way of how we thought of it. The way the franchise tax works is a company begins with their total revenues. From that, they are allowed a choice of deducting either cost of goods sold, which works real well if you're selling goods, if you're in the business of selling goods. But if you're providing services, it doesn't work so well because you don't have any goods sold to cost out. Or you can deduct compensation, or you can take sort of a standard 30% deduction across the board. The tax in its first year, instead of generating the anticipated $6 billion, it generated about 75% of that. We ended up at $4.5 billion. I'll tell you that actually alleviated one of our major concerns. As originally designed at $6 billion, Texas would have had, relative to our economic output, one of the highest business taxes across the 50 states. So ironically, the fact that the tax didn't meet revenue expectations brought it more in line with the business tax burden of other states. Now, I use the term business tax burden carefully because if you look at taxes that businesses pay in Texas, franchise tax amounts to about 1/10 of the property taxes and the sales taxes that businesses pay overall. So while we define the franchise tax as a business tax, the irony is it's not the biggest tax that businesses pay. Nonetheless, part of what the tax tried to accomplish and what Sharp was trying to accomplish was to better align the franchise tax with the modern economy. The old franchise tax had problems, partly because it focused only on corporations, and increasingly in a modern economy, more and more business was being done in the partnership form, which was essentially untaxed. So the idea was to level the playing field, bring partnerships in, lower the rate of the tax, eliminate some of the deductions, and that's sort of how the margin tax evolved. There was also concerns with the old franchise tax that it was an easy tax to avoid. That is not the case with the margin tax. A lot of the bellwether terms you may remember from a couple of years ago, the Delaware sub, the Jeffrey sub, these sort of planning structures that businesses use to essentially avoid paying franchise tax, those are pretty much gone and a part of history now. And they do not offer any tax advantages to operating in those forms under the new margin tax. So if you want to say a couple of things good about the margin tax, you can say that, well, it did eliminate a lot of those tax planning opportunities, those tax avoidance opportunities. It does reflect more the forms of businesses that companies operate in Texas today by taxing partnerships. On the other hand, there are probably fewer companies paying franchise tax today than there were in 2006. Largely that's because of the increase in the small business exemption, which, given the complexity of the tax, I think is justified. Another good thing I will say about the franchise tax is that while it was a substantial increase in the business tax, it ended up being, instead of a 100% tax increase as planned, it was still a 50% tax increase. And I think Representative Perry will agree that a 50% tax increase will get your attention. But if there's something good to say about it, it's that that additional revenue was not used to grow government. It was used to buy down property taxes. So, you know, I can offer a positive about that. That said, there was a cost to moving to this new tax regime. And some of our other speakers will talk more about these, but I will point out from the standpoint of most taxpayers is regardless of what choice you make under the tax, it is still a very confusing tax, particularly if you claim cost of goods sold. Now, for professional tax nerds, cost of goods sold is sort of a common term that people understand. It's a federal term. It's used as a part of a federal business tax return. Unfortunately, the state adopted their own definition. And cost of goods sold is written into state law so that companies have to maintain a separate set of books calculating their state cost of goods sold to generate a number that's different from their federal cost of goods sold. So while we use similar terms, they're defined differently, and that creates some confusion. I would also say, now as with any new tax, it takes a few years to dot the I's and cross the T's as administrative cases are heard, as judicial cases are heard, and as we get some clarification from the courts as to exactly how the tax applies. While that's to be expected, it still is a period of confusion for taxpayers. I would also observe that there are a number of disparities within the franchise tax, and I know Peter will talk about some of those, but basically a business can be competing against another business for the same customer, yet have substantially different tax liabilities. An example of that, I think probably one of the most interesting cases right now is one that is being pursued by a rent-to-own business, Rent-A-Center. And basically what they do is if you go into Rent-A-Center, you can buy a television or a piece of furniture through a rental agreement, just the same way you could walk into a Best Buy and buy it by putting cash down. Now, they're competing for the same customer, but Rent-A-Center is viewed by the controller not as a retailer, in which case they would be taxed at 0.5%, and they would be able to claim a cost of goods sold deduction. The Rent-A-Center is viewed as providing a service because they're theoretically renting goods before the title transfers. So the controller considers them under the standard industrial classification code as a service company. And that means that they are taxed at 1%, as other service companies are. And because they are considered to be providing a service, they're not eligible to claim cost of goods sold. So Rent-A-Center basically is in the position of competing for the same customer as Best Buy, yet they're paying twice as high a tax rate, and they're not able to take as generous a series of deductions. And I think that's really an interesting case at the heart of people in uniform that we'll get some guidance on from the courts in the coming months. You know, there are also issues with companies that provide mixed services, mixed activities. An auto repair shop, for example. They are selling tangible personal property and selling repair parts, but they're also providing a service in installing them. Under the law, they're considered a service company because that's how their industrial classification falls. However, they may be competing against a standalone retailer that is only selling auto parts, yet they're at a competitive disadvantage. So there are a number of competitive disadvantages within the franchise tax that are causing problems for certain businesses, and I think those need to be recognized. So far, the indication from the courts are, though, that at least for now, some of those classifications may be acceptable because there's enough of a policy distinction that allowed the legislature to come up with those. That said, I do think there are some challenges going ahead. One is trying to level the playing field, and it's very difficult given the way the tax is currently structured. Basically, to put competitors on a level playing field, it's going to involve allowing companies to deduct more than what they can now. And that will have a cost, that will have a fiscal note. It'd be very difficult, I think, politically to raise the rate of the tax to offset that revenue because that will be looked at as a tax increase, even if it's revenue neutral, because someone is going to have to pay more. And in this environment, I would venture to say that's probably a very challenging proposition. I do think, though, that there probably is a simpler solution out there than the current margin tax. I don't know what it is, unfortunately. It is a very, very complex tax as it currently stands. Usually there's a price to simplification in that someone, as I said, on a revenue neutral basis is going to have to pay for somebody else's relief. That said, I think the notion of getting rid of the franchise tax probably has some merit, but as with any tax discussion, you have to be worried about what the replacement might be. But that, in a nutshell, is sort of our observations on the franchise tax. Talmadge, I'll turn it back over to you.
Thank you, Dale. Next, we have Mr. Jimmy Martin, lead counsel in the all-cat claim service case, partner with Martins, Todd, Leonard, a law firm that specializes in Texas and federal tax litigation. He's a seasoned instructor on tax law at the University of Texas School of Law. He's also a certified public accountant and does some teaching for accountants in that area. Welcome, Jimmy Martin.
Thank you very much, and thank you for inviting me to speak today. In my presentation, I'm going to take you through just a run through of where we are with litigation on this tax. And I think in looking at the cases that have been tried, the ones that are going to be tried, we can get a sense of the various types of problems that we're sort of seeing in the trenches with this tax. Starting with the first two cases that were tried at the Texas Supreme Court. I tried the Allcat case, and Peter Nolan tried the Nestle case. The Allcat case concerned whether or not the margin tax itself was unconstitutional because it was a tax imposed, a net income tax imposed on a natural person share partnership income. The court did not find one way or the other as to whether it was a net income tax, but instead the court said imposing a tax on a partnership is not the same as imposing that tax on a partner, on an individual. And as a result, they found the tax constitutional. I'm gonna have Peter speak with you about the Nestle case. I'm gonna skip past that, and we'll move into the cases that have been tried. There have been 3 cases that have been tried in state court. Our law firm tried all 3 of these cases. The first was the Taylor and Hill case. That was a professional engineering services firm for which the taxpayer sought a reduction in the tax base for the amounts that it was paying to its professional engineers that it was sending out to refineries and manufacturing facilities. The court allowed them the exclusion there. The next case is the New Park case. New Park is an integrated oil field services provider. The comptroller took them as a combined group, extracted one of the subsidiaries out of the combined group, which was a disposal subsidiary. As part of its integrated oilfield services, New Park provided drilling mud to offshore drill sites. When this mud is used, it gets circulated back as waste and then transported back to shore where it's injected in salt water or injected into disposal wells. Well, New Park, this subsidiary, sought a deduction for the payments it had made to barge contractors for shipping this waste mud across the Gulf of Mexico where it would then be injected. In that case, the court found for New Park and allowed them a reduction in the tax base, either a revenue exclusion or cost of goods sold deduction. The court wasn't specific about which. And New Park won that case. The comptroller has filed a notice of appeal. Their brief is due November 21st, coming up here in less than a month. The next case we tried last week or a week and a half ago for an aggregate haul. The name of the taxpayer is Titan Transportation. They pick up aggregate materials from quarries and deliver them to construction sites where they enter the construction gate and they deposit these materials where they're told to deposit them by the general contractor. They sought a deduction or a reduction in the tax base for their payments to the independent haulers. That is, they don't own their own trucks and they don't employ their own drivers. They subcontract out that work. And the lion's share of what they spend is to move the gravel, the aggregate base from the quarries out to the sites. They sought a deduction, cost of goods sold deduction, or a revenue exclusion, that is a reduction in the tax base itself for these payments that they were making to the independent haulers. We lost that case. The court said in that particular instance, they owed tax, basically on their gross revenues, reduced by the statutory 30% deduction that Dale alluded to earlier. Here are the cases set for trial. We've got these cases set through, these cases are set through about July of next year. The Renter Center case Dale spoke about, I won't talk about that. We have a case set for trial in March. This is a seismic company. They put devices, I think geophones, on the ocean floor that receive concussions from explosions, and they can measure underground what the formations are. And the question for Veritas is whether or not they're entitled to reduce their tax base by the cost of developing this data. The comptroller says, well, that is an intangible, it's not a good, and therefore they're not allowed the deduction. Veritas' position is they get there two ways. They get the reduction two ways, either like contractors would, working on real property, or they get the deduction as a result of the definition of cost of goods, which includes sound recordings, and they view their product as something akin to sound recordings. The next case is a oil and gas case, E&P case, set for trial May 6th. BASA sold a net profits interest to another party. Under BASA's business, they receive 100% of the proceeds from wells. They have sold 96% of that out under a net profits interest. So when they receive $100 of oil revenues, they've got to pay 96 cents out, leaving them with 4 cents. The comptroller says they owe tax on the full $100 in my example, rather than the 4 cents that they retain. And so the issue we have in BASA is whether or not a net profits interest is sufficiently akin to a stock or a security, in which case they'd be entitled to the cost of goods sold deduction if the court so finds. The next case is Flint Energy. Flint is also in the oil and gas business. They send workers out to remote locations to repair or build pipelines. In the course of being away from home, they incur greater living expenses because they're not at home. Those living expenses are duplicated. And so Flint Energy pays them a supplement to their wages, a per diem, to take into account the additional cost of living. And the question for the court is is that additional payment, the per diem payments, are they in the nature of compensation to the individual, or do they in which case they would be a direct cost, which would directly reduce the tax base, or do they constitute a non-deductible cost, such as hotel cost, food cost, and so forth. We had that one set for trial July 1. And then finally, the last case is an insurance company case. This is a case for a surplus lines carrier. These are insurance companies that operate outside the state of Texas, but do insure risks here, and primarily those risks that in-state companies don't want to insure. And the question for the court there is a surplus lines carrier exempt from the franchise tax? Regular insurance companies are, so the question is, how will they fare? Okay, cases not yet set for trial, but cases that involve important issues. First, the Deer Run Basswood case. I don't know a lot about this case. It's not ours, but it does deal with unitary taxation and passive income issues. The next case is the graphic packaging case. And for those of you that are familiar with the Gillette case out of California, the three-factor MTC case, this is Texas's version of the California Gillette case. And that is, can an outsider, can a company come to Texas with its operations principally outside the state and require Texas to allow it to divide up its tax base based upon where its property, payroll, and its revenues are located, not just where its revenues are located, which is Texas's default rule. The next case is Celtex, a throat breakage case. And this is different than a true transportation company. In the case of transportation, the transportation company receives the legal obligation to move the freight. With a freight broker, it is simply a middleman who finds a customer that needs freight moved and lines them up with somebody with the ability to move the freight, puts the two together and gets a fee for doing that. The question for the court there is, does the freight broker company owe tax on the gross revenues it receives, which includes the payments that have to be made to the transporting company, or does it pay tax just on its net fee? The Service King case, Dale explained this case. This is an auto body shop that seeks the benefit of the 0.5% rate for the reason that it sells more parts at retail, over the counter, and installed than it does in generating revenues from other sources. The Winstead case, this is the case Peter is going to argue on cross motions for summary judgment in a little over a month from now. And it involves the issue of whether or not law firms and other professional service firms can include as benefits things like parking, continuing legal education, and so forth. Legislative options. From my perspective, and I realize this may be something we want to come back to, we could just jettison the entire margin tax and go to a true net income tax. I see also a transition back to the old earned surplus tax, but with the tax base expanded to include all the entities presently subject to tax. Limited partnerships, limited liability partnerships, trust, and so forth. And then finally, if we're going to keep the margin tax, I've got a series of suggestions about things that could be done by our legislature to make the tax itself more equitable. I'll live at a time, so I'll leave these discussions to the end of the session.
Thank you very much, Mr. Martin. Our next speaker is Peter Nolan. He's was the lead counsel in the Nestle USA case. Experience is in representing small business, local, Fortune 500 companies, regulated companies, and state governments at all levels of the judiciary, including the U.S. Supreme Court. Their concentration lies in government enforcement, regulatory actions, commercial litigation, insurance, regulatory litigation, and defense. And I'm told that Mr. Nolan defended the Alamo and lived to tell about it. Please welcome Peter Nolan.
I like to say I successfully defended the What I'm going to talk about is this Nestle case and whether anything changed as a result of the Supreme Court opinion. As you were told earlier, the Supreme Court did not overturn the margins tax case that we challenged in the Nestle case. So has anything changed? Well, a couple things. You want to keep it there? All right, here's some things that stayed the same. What the court pointed out is that the current franchise tax is basically, is based primarily on revenue and only secondarily on capital. No matter what you call it, it really is kind of an income tax. And what it did was it expanded the base to go for more types of entities, the partnerships that you've heard talked about. Now what Nestle contended was that the franchise tax must be measured by what you're taxing. That is the privilege of doing business in Texas. That's kind of an amorphous term. That is what the object of the tax is. And what Nestle argued was that because of all the deductions and exemptions, the tax assessed bore no reasonable relationship to the value of that privilege. And it said that it treated, as you've heard today, companies that seem to be similar, it treated them differently. We argue the court said the Texas Constitution has always provided taxation shall be equal and uniform. And then it made a distinction. It says taxation is equal and uniform, not necessarily taxes. I'm not sure exactly what they mean, but I think they mean that if you are taxing the same thing and you go about taxing it the same way, it doesn't mean that everybody will pay the same tax. It simply means you're going to derive that tax in a similar manner for all taxpayers. I want to point out something. We basically argued that the franchise tax was closer to a property tax and how it should be applied, and the state argued that it was closer to an occupation tax. That you could have all of these classifications. As you know, in an occupation tax, you can have a classification for every occupation. And the court seemed to say, look, you're both kind of right. And we think they were closer to what we were saying. They said an occupation tax should be treated like a property tax. And they say in the middle here, in that sense, valuation is the same as for real property, even in an occupation tax. What we pointed out to the court was all of the cases did something strange. When they were talking about occupation taxes, they would have what we call dicta. That's when the court's just sort of talking, it's not necessary to resolve it. And that dicta would say, well, you can basically have an occupation tax for any sort of reason you want. But when the court wrote what was necessary for their holding, they said the occupation tax, even the occupation tax, must be tied to the occupation. So if there's no reason to make a distinction between left-handed barbers and right-handed barbers, you can't make those two different occupations. You've got to have a real reason for this distinction. And then the court went on to hold that the classifications necessary to assure equality and uniformity in occupation taxes are equally necessary for franchise taxes. So they are going to look at the classifications of franchise taxes and see if they make the tax more equal and uniform. What the state argued was that the legislature has wide latitude to pursue multiple policy goals through the creation of rational classifications within tax legislation. The state argued that our state taxes could look just like the federal income tax. That you can pick winners and losers, and all you have to have is a reason for picking winners and losers. Any reason. It can be completely unrelated to that which you're taxing. Therefore, if you want to increase employment, that's a good reason. If you want to save the whales, that's a good reason. It's almost unbounded latitude. And what the court has said was, we think this argument cuts much too wide a swath. it would reduce the equal and uniform clause to merely a prohibition against irrational legislation. And then the court set out what they said is required in any tax, any franchise tax. First, they said the legislature may pursue policy goals through tax legislation, that's fine, but only goals related to the taxation, to that which is being taxed. That is the value of the privilege of doing business in Texas. Second, they said, or further, the franchise taxes classifications must relate to differences in doing business that affect the value of the privilege. Now, what's important about that is there are all sorts of things about business that you could do. For instance, we want you to hire more people, or we want to encourage this sort of business or that sort of business. And they said, that's not enough. If you're going to classify people, it must relate to differences in doing business that affect the value of the privilege. And they went on to explain this. They said the granting of the privilege to transact business in this state confers economic benefits, including the opportunity to realize gross income and the right to invoke the protection of local law. If you're forming a business that's protected by local law, you come within the franchise tax. And they reiterated that Texas franchise tax is a tax on the value of this privilege. We had argued all along that the Court of Appeals here in Austin had gotten it right in a case called Bullock versus Sage Energy Company. And what that case said was taxation, this is the franchise tax, cannot be uniform unless the value of all property is ascertained by the same standard. Now, it doesn't have to be the exact same method, but the same standard, what we're trying to get to. And the state argued that, no, that case is just wrong. You can use as many different standards as you want. The Supreme Court said, no, Bullock versus Sage Energy Company is right. There's some old case law we pointed out to the court, which suggested that you must use the same test. You're going to use weight, you use weight for everybody. You use height for everybody. And what the Supreme Court was basically saying, well, if weight will get you to a better value of that privilege of doing business in Texas, you can use weight. But if for some companies height gets you to it, you can use height. So they're saying you can use different tests, but you've got to be measuring the same thing. That is the value of the privilege of doing business in Texas. What we argued was that, we argued that classifications were not permissible if they're unrelated to the value of the privilege of doing business in Texas. And what the court said is, while we agree that a classification and a tax must be related to the object of the tax, we believe the legislature must have discretion in structuring tax laws. So they said, look, we're going to give them, we're going to be a relatively low bar on whether they're trying to value the privilege of the business in Texas. And then they went on, and I'm not going to go through all these, but they basically said, you haven't shown us, and all these things you're complaining about, and we didn't complain about all the deductions and exemptions and different treatments. We complained about some. And what they said was, look, you haven't shown us that there couldn't possibly be a reason why the legislature could have thought that that tax actually is better at valuing the privilege. And therefore, we're not going to uphold any of the challenges that you've brought. And how the court phrased it was, we didn't challenge every deduction and exemption. What we argued was that you can't have this many deductions and exemptions which don't seem to have a common theme. It seemed that many of these were just sort of ad hoc. Well, look, we realize that this tax is unfair on this group of people, so we're going to try and make it better for them. And we realize the tax is unfair on this group of people, so we're going to try and make it better for them in a different way. And we realize the tax is unfair on this group of people, so we're going to try and make it better for them. And our basic argument was, unless you do that for everybody, if you try and make the tax fair for everybody, fine. But when you only try and make the tax fair for some people, then by definition, it's not equal and uniform. Because although you made it fair and equal and uniform for 1, 2, and 3, when you left out 4 through 99, then we argued that as a matter of law, that was not equal nor uniform. And the court said, well, on your 1, 2, and 3, we can think of some reasons. You really didn't bring up 4 through 99, so we're not going to rule on that at this time, but on those things you did bring up, we find you haven't presented enough evidence to convince us. The reason I bring that up is, I don't know that the argument is necessarily over. The court didn't say this tax is constitutional and cannot be challenged again. What it said was, you haven't brought us, and we have a pretty heavy burden, you haven't brought us the facts, the figures, the analysis that we need to say that on the things you complained about, the tax is not equal and uniform. What the court did do is it confirmed the basic argument that Nestle was making, that equal and uniform taxation means something beyond a prohibition against irrational legislation. You really have to tie it to that which you're taxing. And as the court said, the franchise taxes classifications must relate to differences in doing business that affect the value of the privilege of doing business in Texas. And the last one, the court added that the tax must relate to the value of this privilege. But then it stated it would give the legislature broad discretion in structuring tax law, and using that broad discretion, the things we brought up, they said, close enough, you have not shown that these aren't proper. What I learned in doing this is that the state set out to make a tax which is broader based, good idea. Started out to make a tax which eliminated some of the games that companies were paying to get out of paying the tax, good idea. And then set out to make the tax equal and uniform for some taxpayers. That's some of a good idea. And what we learned was, and we had a bit of a catch-22. We got to go directly to the Supreme Court. The law said we don't have to go through a district court where we normally develop a record and put in all these statistics and everything. We got to go directly to the Supreme Court. So we really only had a record of those things which everybody agreed upon. I think the Supreme Court's opinion leaves open the possibility of future litigation if someone does want to go through the district court, develop a record, if things are unequal and not uniform, that they can show them. So I think it's still an open question as to whether this can be challenged or not. And one of our suggestions, I think, and we can talk about this more later, but one of our suggestions would be we can go back to a simpler tax which broadens the base. We can go back to a simpler tax which prohibits the funny business that people were using to get out of this. And we may want to go back to something which doesn't have so many different treatments for so many different tax waivers, both because it'd be simpler to comply with for business, and two, because it's perceived as being more equal and uniform, and three, because it actually will be more equal and uniform, and would not be subject to challenge, and might be better received by those who are being taxed.
Thank you, Mr. Nolan. Next, we have Representative Charles Perry, elected to the House of Representatives from District 83 in 2010. District 83 includes part of Lubbock and 6 other neighboring West Texas counties. Representative Perry currently serves on Corrections, Defense and Veterans Affairs, and Rules and Resolutions Committee. Representative Perry is a practicing CPA with his own business. Representative Perry.
Thanks, Talmadge. Thank you for inviting me here. And wow, isn't this exciting stuff? Man, I tell you what the 2006 Franchise Tax Act was. It was the Accountants and Attorneys Reemployment Stimulus Act. As you can tell what's going up here today, and that's a sad statement of legislation in general. Number one, as a practical matter, as a practicing CPA, it is not working. It has cost my taxpayers in compliance cost alone untold dollars. I will tell you, I do probably about 1,000 tax returns. Of that, about 700 are business or corporate entities. I would rather do a federal with 25 state returns attached to it that cost about 3,000 pages of paper than to do one Texas franchise tax return that is a hybrid classification. That is the system we have created. That said, you know, number one, I look at it this way. I'm gonna kind of give you a little practical cost, give you a couple examples, and then tell you where I think we ought to move back to as a legislature and as a tax system in Texas. Number one, there's only one checkbook that matters to me, and it should be the only one that matters to us as a legislature when we do things. That's the consumer's checkbook. Anytime we raise business cost or a paycheck cost, consumer's check's gonna go down. They're gonna make that up somewhere. So we always gotta be cognizant of the fact. I have a service hybrid company in Lubbock, Texas. They're gonna approximate probably 20 million this year. They were a service company. They did service work. For someone in the legislature to tell me that my cost of goods sold should look like 30%, when they don't know my business, I spend $120,000 per truck because they're unique to an industry that demands that, and I have to hire $40,000 to $50,000 service tax. 30% is not going to get that done. It costs me more to get money out the door than it does. So I really think we've overstretched, and we didn't have our facts right, and we didn't have a practical application on life experience to apply this to. Their case is they're paying under 10 grand in franchise tax under the old law. They are going to approximate close to $40,000 this year. What does that really mean? Well, that's half of a truck. That's probably one receptionist or two or one service tech. It matters to those guys. Similar situation, I've got a company that is a software/hardware provider to cash registers for grocery store chains. Does very well nationwide. They got into the business of maintenance contracts. Now we've got a hybrid. So this SIC code, this code that we determined what a taxation would look like underneath of the system, doesn't work in practical real life. Because truth of the matter is, entrepreneurs and businesses are looking for every opportunity to add revenue to their bottom line. And it may not fit the little box that we did as a legislature to set that out. So as we go through this process, number one, it probably shouldn't have been done. Our goal was to relieve property tax owners, and you know what? We didn't even address that issue. We went off on a different tax. Anytime you give the state or the government more tax, you grow bigger government. But we didn't address the problem we're trying to solve, property tax. We didn't fix a property tax appraisal cap. We didn't fix the subjectiveness of it. So appraisal creep took out what we intended to do to begin with. Short-sighted. And I think the legislature needs to be real cognizant of this. You go after one problem and you don't fix it, but you add something else to it you thought was going to fix it, it just opens up more funding. We'll get in trouble. So we didn't even do what we set out to do with this case. I think here's where we're at. Bottom line is we missed the boat. And it's cost, I think, Texas jobs that we don't know about today and will continue to cost us jobs. It's complicated. My practitioners, my colleagues and my peer groups don't like it. When we ask questions about how to administer it, they'd say, well, I don't know yet. Comptroller would do seminars, we don't know yet. You guys are going to have to give us a couple years of data. We're going to come audit and tell you we like the way you did it. If you didn't do it right, we're going to correct you. You're going to pay all this other stuff, and then we're going to put that in law as much as the way you did it. So it was a poorly construed, poorly implemented tax. I do agree with some of the comments up here, probably well intended, but then the politics got in the way and messed it up. So where I'm at today is I think in order to, I'm not going to take my whole minutes, don't leave some question and answer time. We got to move back to an earned surplus tax. And I think the gentleman here said it. You know, if you just took what we had and expanded it to every entity in Texas and put in a compensation cap, as a practicing CPA, what we used to do is play games. We come up with, in the old system, you pay on either net income or your surplus, what you call that. But we'd bonus out a big salary year in and drop the earnings, there'd be no franchise tax, and give it back to the company to go after. So what I think we ought to do is move back to the hybrid of an earned surplus model, keep the compensation caps that come through this system in to keep the games from being played. But it's put on earned surplus. So if a company has an earned surplus that they want to keep because they don't need to reinvest in more equipment or people, they earned it in Texas, there is a cost. Texas is a privilege to be business here. There's a cost to that privilege, so we need to recoup that cost somewhere. The way we're doing it today is not accurate, not right, and reflect. Keep your surplus, then you pay a little tax on it. If you want to reinvest in more employees, more capital, more jobs, and grow your business, your surplus will reflect that. It will be less. So it's an incentive to spend your surplus. It's an incentive to put your capital works. That's what the old tax kind of had in its underlying nature. I can't tell you what this one did other than just more revenue from more government. That's the truth. They used it as a vehicle to get to where they wanted to be, and they put it off on property tax relief, and then they did nothing for property tax relief with any substance to do that. So I'd move us back to the earned surplus. I do think that as a CPA, I've got a large amount of companies that do multiple entities, and some of them are used, some of them aren't. There is a cost of compliance. You know, the comptroller's got to invest in infrastructure, hardware, storage, and those things. So set a minimum return fee, $200 a report year. I don't know what those numbers look like, but we need to go back to where we started and redo what we've got, because what we've got is not working. Several other deals. We've got 2 ownership reports attached to this. We've always had them. One's a public information report, one's an ownership report. The difference being one's disclosed to the public who owns your company, one's not, one's private partnerships, one don't. I can't tell you how much time in a CPA office you get. We filed an ownership report, we should have been a PIL report this one. Combine the reports, just administratively do some things better. But we gotta get off of where we're at. It's not good for Texas. It's not good for the system. The Pandora's box is open. We've already generated, we do about $8 billion by any amount of this tax now. We've allowed property taxes to creep up again. So we've negated what we intended to do. You can't get the $8 billion off without replacing it with something that's gonna be a ways and means neutral. But we've got to begin that process of unwinding and moving, because the cost of doing business in Texas, we say one thing, and we do something like this, it's a hypocritical position. We are not cost effective when it comes to this tax. We do pick winners and losers. That's not fair. I would tell you as a CPA, I have a capital cost. It's called employees. The difference in an employee and a piece of equipment that a manufacturer has, they come and tell me when they're ready for more money. So there is a cost of capital in the service business. I will tell you, as I write those paychecks every 2 weeks, I have a cost of pushing out my product. And under this system, they treat it as if there was no cost. Basically saying, no, you don't really need that capital. So I think there was just a really bad policy, bad information, and then when you mix special interest and politics in the mix, you get this admonition of a monster that nobody can tell you what it looks like, how it acts, or what it should be. So it's time to undo it, try to revisit how we get out of it. Thank you.
Thank you, Representative Perry. I'd like to take just a couple of minutes for the panel to discuss among themselves if there's something that's been said that someone thinks needs clarifying, or maybe has an expansion on that. Is there any questions that y'all have with each other, or like to expand on any of the comments that you made?
I could. I'd like to ask Peter and Jimmy, I don't mean to dwell on it, but I think the Rent-A-Center case to me is very interesting, because they're talking about a company that competes with someone else who has very differential tax treatment, but they're competing essentially for the same customer. Do you think that the facts in the Rent-A-Center case can meet the new test that the Supreme Court has put in with regards to the classification value of the franchise tax? I mean, could Rent-A-Center meet a test that Nestle could not?
I think Rent-A-Center facts are much better, and I think they'll be developed, and I think it's going to be much harder to say that the discrimination against Rent-A-Center is justified by a difference in the value of the privilege. But I think it's just what Representative Perry said. When this was being done, I think there were some good ideas
is based on previous tax revisions, the amount of time it generally takes to sort them out through the courts or through administrative changes or legislative action. Where do you think we are in the cycle of the margin tax if there are no appreciable changes made by the legislature? In other words, are we a third of the way through the litigation process, or just beginning? And will there be administrative changes that will tend to clarify in years to come? Are we 3 years away of having it settled? Where do you think we are within that process?
Well, I would say this. We are handling about 10 cases right now that we believe deal with virtually all of the substantive issues in the tax. We've litigated 3 of them in state court, have about 7 more left to go. And I think once we get through that litigation, we'll be about 80% through what I would see are the critical issues in the tax.
And just reiterating what I said before, I think that the Nestle case did not close down the challenges to the margin tax. There are some that are factual, like they're all going to be factual now. And I might see even a little more litigation coming out, some things you and I have not addressed yet. And so I see it perhaps as lasting 2 or 3 years more litigation.
And I think you're right. I mean, we still got to go through the appeals process as well for the cases that we're going to be trying in district court. And Peter, in all of the, I think in virtually all of the cases that we filed in district court, we have pled constitutional claims as well as
Yeah, I think we're farther along on the types of cases that are focusing on constitutional issues that go before the Supreme Court. I mean, I think there are fewer and fewer cases out there that would result in the entire tax being thrown out. But I think we're very early in the process of sort of those traditional cases where we're looking to get the I's dotted and the T's crossed. And the more traditional tax cases you see, I think we're still very early in that process.
Question from the audience. We have a question over here, if you would.
Oh, okay.
Can you get my mic? So we can get you recorded.
Okay. Well, my question really is for Charles. All the businesses in Texas either do an 1120 or a K1, right?
Not all, but okay, I'll go with you, but no.
Well, they're all doing some kind of a federal tax return.
Correct.
Why is it that we can't just take the federal tax return and apply a percentage to that and have that as backup to the state tax?
This goes back to my comment earlier, and I would rather do a corporate return with 25 states other than do a Texas franchise tax return. Reason being is all those lay over the federal. They take the federal return and they just work off of that, so there's no additional Excel spreadsheets outside of the real world to have to calculate the Texas franchise tax. And, I was going to read this. I pay about $30 grand a year for my software, to do my tax software. That's, for a small practice, that's a substantial amount of money. The diagnostics, you get a little sheet after every return that says, here's some things you might want to consider. Every one of my business returns. Texas, the amount of cost of goods sold that is used for Texas franchise report purposes is different than is used for federal tax returns. The amount used for Texas franchise report must be entered on by manual. So, I mean, it just took everything that's electronic and moved it into a manual system. And you know, cost of goods sold is cost of goods sold. Federal government's done a real good job for the last several hundred years of defining what cost of goods sold looks like. But we in Texas decided we got to do something different. So that's kind of nuts when you really put it in perspective. Here's one of my amendment, or my deal. You would take the first 4 pages of a federal business tax return. And there are some people that have single member LLCs that only file a personal return, but that set aside. Take the first 4 pages of any business return and it will list on there your surplus, your retained earnings, if you will. That immediately feeds into your tax software. That's your .0025 base. You add back your compensation limit that's in excess of 300 grand because that's where the games are played. In the old days, that number goes up to kind of make up some of the revenue shortfall, but it's automatic, it's easy, it's calculated, and the business owner may decide, you know what, I could buy a piece of equipment, and I don't think we go back to the old way where Texas had a different depreciation system than what the federal system has too, meaning that if Federal law says I can expense $500,000 of purchases this year because we're in an economic slump and we want to stimulate businesses to go out and buy, and I get to write that off federally. Let Texas do the same thing, because the idea is if federal's doing it to economic growth or stimulus, tax packages are built around policy to do something typically, then let the state follow suit, and then next year, if that law doesn't exist, you're gonna write 100,000. What Texas did, don't create something different, but allow that to be an add back to your surplus for compensation. But if you get to expense it 100% federal, let the Texas expense it 100%, because the theory ought to be applicable. We shouldn't be inconsistent with what federal and Texas are trying to do. But you can do that today. Multiple states do it. Go back to the earned surplus. As a business owner, I may decide to buy that half piece of $1 million equipment, or I may say let it stay in surplus. There is a cost to doing business here, guys. Don't hear me out. I mean, we have a great legislature that puts things in place to hopefully let business survive. What is the cost of that, though? It's a privilege to do business, and what is the cost we got to basically recoup through that process? This became tax revenue instead of privilege, and I think that's where they missed it. I disagree with everything the courts did in Nestle. I think Nestle did a great job of putting it out there. I think what he said earlier was, is we're going to go back now and nickel and dime away what we did. But think about the million. I'd love to have an estimate from LBB of what the comptroller spent, the AG spent in defending this now, and see what the net tax was out of the franchise tax system. It's just nuts.
Other questions?
I too am a CPA, and I concur with a lot of what Representative Perry said. And I can guarantee you, I don't do as many tax returns as you do. But I do a lot of advising to serial entrepreneurs, and I can guarantee you that a lot of them are not setting up businesses there in Texas, especially guys who are in hybrid service businesses because of this tax. The regulatory time that it takes to implement it and the costs associated with doing it, it's a lot cheaper to go to Nevada or another state in Texas. So that's something the state legislature better address, because the way the tax law was written was, as you kind of hinted at, it's all based on these SIC codes. That's 1950s, 1960s mentality, and it's really hurting as our economy has grown into a more of a service-oriented, hybrid, technology-type driven arena. We're losing, I think, a lot of business because of it.
Any comments on the comment?
Yeah, I'll make a quick comment. Don't go to Nevada too fast, because they have a margin tax on the ballot. The labor unions, and through the initiative and referendum process, have put a margin tax proposal on the ballot to generate additional funds to put in the public school system. So there may be other places, but Nevada probably isn't it.
Other questions? I have another one that, in a paper that we have introduced today, talks about phasing the margin tax out.
Now, I don't know whether you caught the word phasing or not. We didn't say replace the margin tax. You said phase it out by raising the floor. It's currently at $1 million. In each legislative session, it kind of goes, well, we're going to do 300,000, 600,000, or $1 million. Raising the $1 million to $10 million. On the first $10 million, you make the subject. You don't consider it, and then the next session going to 50 million, and then going to 0 from that. But phasing it out, giving the economy time to make up for the loss of revenue, and also giving the legislature time to continue to trim back on the footprint of state government. I'd ask the panelists, do you think such a system would be workable, and do you think it would be perceived that the business would no longer pay taxes, even though, as the panelists pointed out today, the margin tax is only about a tenth, I believe, Dale, you said, of the is paid by business. So what do you think about it? Give us some comments.
Well, I'll jump in while others formulate their thoughts. I think if you're going to phase out the tax, the way to phase it out is to slowly or rapidly reduce the rate, but not do it by increasing the exemption, because ultimately what will happen is that exemption is going to get frozen at some level, and folks will realize, well, if we freeze it at this level, then only 20,000 big businesses will pay the tax, and that's fine. And for good tax policy, I don't think that's fine. I mean, I think the more people in the system, the better. That keeps the focus on making the system fair. That whenever you have a tax that is very narrowly applied to a small number of folks, it's very hard to generate political impetus to keep that tax as fair as possible. But if you're looking at maybe reducing the rate over time, you know, I think that's a better way to do it. I will caution that right now the franchise tax is linked to school finance and property tax replacement. My only concern is if phasing out the tax is going to be an invitation for school districts to raise their property tax rates, then all we've done is replace one tax with another as opposed to getting rid of one. So I think there are a number of things you have to be careful about.
Well, I think Mr. Kramer just hit my concern. I don't know that doing it through the exemption process, I agree we need to repeal or phase out. How we go about doing that and what we replace that revenue with is critical to me, and the details, the devils in the details. But more importantly, until you deal with the property tax issues, school finance issues in a proper way, I don't think you can go down this other road until you kind of have all of your ducks. You got to think globally in this process, I think, because this is how we got in trouble. We thought silo. We didn't think about fixing everything kind of as we went. We kind of targeted a group and fixed it. But I'm not sure the exemption is the right way. At the same time, I think we do need to start that process, and I'm going to push kind of to move back towards the earned surplus route.
I agree. I think we ought to go back to the earned surplus route, and then you've got flexibility in the rate. But the earned surplus route does a couple of things. One, it puts the fairness back into it. And the second thing it does is it gives you flexibility if you want to deal with rates. You can do that, and I especially agree that until we find out, there's a whole bunch of moving pieces in here. School tax being a huge one. Until we figure that out, I think we ought to fix the margin tax anyway, and then once we get it into a position where it's fixed and it's fair, then once we figure out the facts from these other things, then we can come up with a comprehensive plan that will address all of it.
And I agree. Going back to the earned surplus, in my mind, is a good idea, not just for what's been said, but also for the reason that an out-of-state business can understand the earned surplus tax in relation to other states' taxes. Most other states tax net income, and they piggyback off the federal returns. The earned surplus tax, even though it's not called a net income tax, I think everybody would agree that it is a net income tax, and it does, with adjustments, piggyback off of the federal income tax. So if I'm an outsider, if I'm somebody outside the state of Texas trying to make a decision about whether to come to Texas or not, it's easier for me if the way taxes are calculated in Texas are the same as they are in the other states, because now I'm comparing apples to apples, and taxes are a concern. I can go with the state with the lowest net income rate, so to speak, whereas with the present structure, it's really hard to say if you're outside Texas when you can when you come here and pay margin tax.
So it appears the consensus is that whatever we do, leave it as broad as possible as long as we have the tax there, and simplified so that businesses don't have to keep multiple sets of books just to accommodate Texas tax policy. Before we wrap it up, you've got a couple of things that you need to do before they will let you out. I think the doors are locked. I think that in your little program here, there was a sheet that you can fill out and tell us how you did, how we did, and what you'd like to hear in coming sessions
that will attract you to come back to visit with us. So I'd very much like for you to fill that out and leave it in, I think, a box just outside the door. We always are very appreciative of your attendance. To come and hear ideas and share ideas. We think that the state is stronger because of that process. Thank you very much for your attendance. The meeting is adjourned.